So I think it's first important to make a distinction between in-force business and legacy business, because the difference between non-life and life business when it comes to in-force is that non-life business you have one premium and then afterwards you have the claim runoff. Whereas for life business, even though you don't write any new business, you will still continue to receive premiums of policies that have been written. So when we talk about legacy business, then within the life context we mean business that the company doesn't want to write anymore because it's too capital intensive, for instance, or because they've got admin issues. It's not a strategic line of business anymore. And main examples for that is, for instance, in the German market, where we see that the interest rate guarantees that they've given is becoming too capital intensive, and that's why it's become legacy business. But basically any life line of business can be legacy business, whether it's mortality business, critical illness, disability, medical expenses, even though that's short-term business, longevity business. Those are all businesses that can become a burden or too capital intensive for a company. So the first market that has become very active in spinning off legacy businesses was the US, partly driven by consolidation, but there were many companies that were simply also too small and couldn't keep up with the competition anymore. The next market where we've seen a big increase in consolidation and also in spinning off legacy businesses was the UK, where we're still very active. And then we now also see more interest in the continent, particularly Germany, as I mentioned in the previous answer, driven because of the interest rate guarantees that companies have. And we expect that trend to continue as well. I think in Australia we also see more and more companies becoming active in that area. Yeah. We've only had very few examples where you could say there was a combined life and non-life need. But in practice, particularly for the markets that I just mentioned, the licenses are split by legal entity. So it's either a non-life legal entity or a life legal entity that they try to solve, and then there is no real need for a combined solution. So I would say rarely there is a combined need for that. Yeah. So I think there is more opportunity if there is a company that really wants to stop doing business and they have life and non-life business. We should be able to work together. As I said, we've had some examples where life and non-life solutions were looked for together, but they've been rare. We can combine them. We can solve finality. We can provide capital relief as well. I think where we can probably reap the most benefits is on the in-force management and lapse management. So making sure that policies are being retained, because still they might be profitable, and then you can reap the financial returns for that. But it's very early days for that. So not directly related to legacy business, but to the management of the in-force business or the renewal of the in-force P&C business, and you want to increase renewal rates, you want to avoid that people are dropping out. I think there is a lot more that we can do there together. On the life and health side, we have got the opportunity to use, for instance, behavioral economics and the knowledge that we gain from that to improve retention rates. You can also use upselling skills for combining life and non-life policies and give a rounded insurance experience to policyholders. So that is certainly something where there is much more ground to cover.